name is Oliver Blockland, Senior Content Producer at Global Invest Group, and it's my pleasure to welcome you all to the ISF and ISLA Securities Finance webinar series. Today's session is entitled COVID-19, A Chain Reaction, the transmission of effects across markets and institutions. On behalf of myself, ISF, and ISLA, I'm pleased to see so many of you have joined us here today. I'd like to thank our 17 sponsors, their logos were up on the holding slide, for their continued support and who've made this event possible. Do please go to the Content Hub at the microsite where you registered to learn more about genuine thought leadership and view white paper materials. In today's 1-hour web conference, we will have a panel discussion of around 50 minutes, and we have set aside some time for Q&A. We have already received a few questions for our panelists. If you do wish to ask a question, you can do so by clicking the Q&A button. Do keep sending through your questions for the panel, and we'll try to answer as many as we can by the end of the session. I'd like to take this opportunity to thank the speakers and moderator for sharing with us your time and thoughts on the topics we'll be discussing today. The session is being recorded, and it is now my great pleasure to introduce Mark Faulkner, who will be moderating this event.
We're very much looking forward to an interesting and interactive debate. Before I ask my panelists to introduce themselves briefly and to check all of the lines of communication have been working properly as we start, I wonder, Oliver, if we might put some questions up for our audience. Right. These questions, which we'd very much like you to engage and answer, and you can scroll down as you see for question 3, because there's not just one answer there, will be referred to by our panelists in the discussion. We reassure you that the submission of your views are anonymous, and we'll be just sending and sharing with the audience what the output might be. So question 1, given the dramatic volatility of markets recently, would you be in favor of the emergence of some form of intraday or dynamic margining capability, yes or no? Question 2, did you note increased difficulty locating or mobilizing sufficient collateral in recent months? Yes or no. And question 3, how satisfied have you been with the technology that you have depended upon through the crisis? This one ranges from very satisfied to very dissatisfied, with it was fit for purpose pivoting in the middle. I wonder, whilst some of you take the chance to fill in those questions, starting with you, Nigel, I wonder if you might just quickly introduce yourself, the role that you have, your company, and then we'll go James, Simon, and then Bimal. So over to you, Nigel.
Good morning, good afternoon, wherever you are. My name is Nigel de Jong. I'm working for LCH, and I'm responsible for the repo clear sales and relationship management across both of our sterling and euro segments in our CCPs in London and Paris. Thank you, Nigel. James?
Yeah, thanks, Mark. Good afternoon, everybody. James Templeman. I am responsible for securities lending trading at BlackRock, as well as having overall responsibility for the business in EMEA.
Thank you, James. Simon?
Good afternoon, everyone. Simon Sorigon, based in New York for Natixis. I'm heading the global securities financing business. I moved over a year ago. I still have a global responsibility for the short-term side of the spectrum, basically securities lending on a global basis. Thank you.
Thank you, sir. Bimal.
Hi, this is Bimal Karikar. I'm the founder and CEO of Transcend. We are a collateral and liquidity next generation technology company.
Thank you very much, all of you. Technology working, we can hear you clearly. For those in the audience, what we've agreed to do is to split up the questions that you will have seen in these sort of flyers for the event into 4 sections, and asked each one of my panelists to kick off their respective session or section. We're not looking for this to be 15-minute monologues. I would encourage any of the audience to submit questions on an ongoing basis. We'll be able to see them, and maybe I can chip them into the discussion. And also, I would encourage my fellow panelists, if they feel the need, the urge, to question one another. This isn't a sort of mark questions for people or 4 different monologues. So James, you've got the lucky short straw and are kicking off section 1 for us. And if I could just start with, what effects were transmitted through the web of agent lenders, market makers, exchanges, clearance systems, money market funds on the back of this rather daunting crisis?
Yeah, thanks, Mark. So what I thought I would do, and hopefully this won't be a 15-minute monologue, maybe a 5-minute recap should cover it. And what I thought I would do is just to kind of go back to March, which is only 4 months ago. It's only a relatively short amount of time, but actually I think it feels like quite a long while because so much has happened in the interim. And it's easy to forget actually just kind of how much carnage was going on back in March as we sit here in these relatively calmer times in July. So just a kind of a quick recap, if you like, back to the first week or so of March and what was happening there. And I think, I mean, this isn't an original observation, it's been said a number of times, but the first thing I'd say is, this was different to the last financial crisis in that it was really a health crisis that had impacts for the financial markets that were obviously being felt quite quickly and severely. The difference from my perspective, having enough grey hair to have been through, the crisis in 2008 as well, was that this time there was an absence of counterparty risk. So we were never concerned about our borrowers. We were never worried that they wouldn't make it through the crisis. They were obviously in a much stronger position now than they were in 2008 through the capital and liquidity buffers that they built up in the interim period. But there was definitely a question about whether markets could continue to function in an effective way. And there was a time when, the whole world was starting to work from home. We didn't know whether or not the technology and the systems could cope. We didn't know whether the Wi-Fi could cope. And if you remember, our attitude to trading from home in particular back then was no way. Like there was no way were traders going to trade from their kitchen or their living room. And now all of a sudden that's kind of BAU. So, but at the time, as we were going into this kind of extraordinary period, that was something that, had never really been contemplated before. It was always a line in the sand that people shouldn't trade from home. So then if I think about what was happening in the markets, obviously companies started to really prepare for lockdown. And so there was a drawdown on liquidity in the whole system, on contingent funding facilities. Balance sheets were being strained at banks, which meant it was tough for them to intermediate markets in the same way that they were used to doing. Equity markets fell 12% in one day. The VIX was up to around 85%. The yield on the US Treasury market was all over the place. All of a sudden, the 30-year Treasury was below 1%. Oil prices were negative for a while. I mean, this was like a crazy time, congested into a short period, much more volatile than back in 2008. And money market funds lost 10% of their assets in 8 days in March, which meant they needed to raise liquidity and sell CDs or CP in the market, and found that they couldn't. And so what kind of got us out of that situation was really a lot of central bank action. I'm going to try my best not to use the word unprecedented, as it's the most overused word in financial markets at the moment. But if I do, just forgive me, because it did seem like pretty unprecedented times. So central banks kind of stepped in and put things like the dollar swap lines in place. The repo market was showing signs of strain. Repo rates had spiked up, so the Bank of England relaunched their contingent term repo facility. There was asset purchase schemes cropping up, which definitely helped money market funds, for example, to sell their assets. So things were starting to improve in terms of the way that the financial markets were actually able to operate. For a while there, it seemed like, particularly in the fixed income world, that the markets were going to absolutely grind to a halt, and there would be no liquidity whatsoever. And so then the third thing I wanted to talk about is kind of what the impact on us as an agent lender was through that time. And I won't go into too much detail here, because I think we'll probably pick up on some of these things as we go through the discussion. I think the hardest thing for us to manage was volatility. Market volatility was so high. I know in a session earlier this week, the industry leaders panel, they talked about the fact the S&P moved by more than 5% for 8 days in March. And so clearly when you have, say, a 102% standard haircut for US equities versus cash, you're going through that on a regular basis. Non-cash collateral trades, particularly with wrong way risk. Again, questions were raised earlier this week in terms of, are these trades really being priced appropriately for the risk that they carry when volatility is that high? And that was definitely our experience. And then from a risk perspective, and just how do you manage risk? How do you manage that amount of volatility? I know from our risk managers were finding it tough. And again, I think this is something that we can draw out in the discussion, because the CCP margin process is very different from the SEC lending haircut process. And then, on the repo side, banks were coming to us to want increased haircuts, but securities lending tends to have very stable haircuts. And so our risk managers were struggling to kind of have a consistent approach to how to manage risk across those different parts of the market. From a collateral perspective, we very much focus on liquidity, and fixed income ETFs kind of really came through strongly through that period as well. I'm going to pause there, Mark, because you're going to ask me a question.
Well, James, I was just wondering whether you're sort of betraying how you might have voted in regards to the first question we asked our audience, and sort of it's leading, your conversations leading us down that track. I mean, do you think we need to be more like the interactive, dynamic CCP margining in this business to learn this lesson and be prepared?
Yeah, I think
the world is boring and there's not much going on. 2% works, but then it adjusts dynamically without having to have this huge friction.
I think that two things should either happen. One is that kind of peacetime haircuts should be wider to accommodate for these periods of volatility, or they should be more dynamic so that they can be lower in more benign times and then increase through more volatile times. Or maybe we're just pricing the risk inappropriately, and actually some of those trades should be repriced, and we can deal with the haircut if we're paid more, because you're just taking on more risk than perhaps you were allowing for with those types of trades.
Thank you. I'm looking to see if Oliver can share the audience response. 58% of people that participated said yes, they would favor some form of intraday or dynamic margining capability. So sorry, I do apologize, 80-20, he just told me 80% said yes. So they're with you on that thinking, I think, James, because of this very recent shock to the system. That's very clear.
Yeah, and again, Mark, it came up in the industry leaders panel. Ben Chalice talked about the need for more standardization, so you can have a better technology layer, which then enables there to be, a more dynamic collateral process. So that may be something that needs to happen before we can get there, in terms of maybe, digitalization is a route there, but I'm probably jumping too far ahead.
Thank you. I'm conscious of the time, and I wondered if you'd like to sort of wrap up this section, and any of my your fellow panelists would like to chip in before we move on to the second set of questions. Any points you'd like to leave the audience with specifically, James?
I think the only other thing that I was going to go on to say is that obviously we were also seeing really high volumes through that period. So Equilend gave me some data yesterday in terms of NGT stats. I think there was about 30 to 40% more trades being processed through March than the previous March. That's when we were all working from home. So the technology seemed to hold up pretty well. That's quite impressive that amount of volume, additional volume, was being managed from such an extraordinary kind of working from home BCP type environment. And then the final thing I would say, again, because we may pick up on this later, from a returns perspective, I think it was quite a good market environment for active fund managers, for short sellers generally. There's a lot of equity dispersion, which is kind of carried on through through Q2 as well. And so, you know, there was also opportunity in this. It wasn't just about managing risk.
Thank you. I've got a question from the audience, which is coming through the chat line. So just one for you, James, before maybe some of the other panelists want to join in and take this a little further. So the question is, will different margin requirements across different markets and products push the market towards a single multi-line master agreement with fungible margin requirements? That's easier to say than it was more difficult to say than to read, perhaps. Did you get the gist of that? I mean, are we looking
I got the
for
gist. Yeah, I think I may know where that question came from as well. But I mean, possibly. It's not something we've contemplated, and I imagine the overhead to get there would be pretty significant, just given that, you know, everyone's legal resource and the scarcity of resources generally. But I think, you know, if there's enough momentum within the industry, it's certainly something that could be looked at. But I have to admit, it's something that we haven't contemplated so far.
Thank you. Okay, I'm going to now look to Bimal to lead the conversation in section 2 of the questions that were put towards us. Bimal, 3 broad questions, if I may throw them in your direction and then give you time to consider and respond. Given the shock that we've just had, what was perhaps expected? What came out of the blue, if anything, was sort of counterintuitive in your experience? The second element, anything that you care to share with the audience that may have amplified or influenced the performance and shocks within the ecos. Based on the lessons learned, what changes do you anticipate can be expected from the business from an operations and technology perspective? Quite a lot there, but I know we're prepared for this. So I'll just hand it over to you to lead that part of the conversation. Thank you, sir.
Fair enough. Thanks, Mark. And I think James laid it out very nicely that I think the crisis was clearly different, unprecedented, as James said. And the challenge, I think, was that it is hard not to compare with the 2008 crisis, right? So I think the big relief for the industry and for the whole world was this was not a credit crisis. This was not, the counterparty credit issues were not the forefront of a lot of the discussion. But if we want to call it a crisis, how it kind of showed in the business or operations platforms was more like a collateral or a liquidity crisis, because all the stress that was felt in businesses or the firm's infrastructure was more around that. And for the most part, I would say the industry systems or the firm systems held up very well. So I think this is definitely a good time for industry to take a high five to say that things work reasonably well. But if you then just open the hoods of how it worked reasonably well, then you find there are lots of challenges that were seen. There was a lot of heavy manual coordination. There was a lot of manual aggregation. There was a lot of spreadsheets flying around. There was a lot of on-demand or on-the-fly risk management calculations were done. So a lot of that was actually what kept the process going. So end result was actually very good, but the ingredients that made the end result good will be a good lessons learned for everybody involved. And the way we see it is that clearly the volumes were very high, volatility was very high, the margin calls were very high, and pretty much all your exposure was collateralized. But the big challenge that at least we saw talking to our clients was that to see what is all the collateral across the firm was a big challenge. So it could be in different silos, it could be in different pools, it could be in different depositories, and having a good view of all of these things together was a fair bit of challenge. And not just collateral, but just to see your margin exposures, especially when you look at the different processes as we talked about. CCPs are going through much more dynamic intraday processes, whereas some of the sec lending processes are a lot more kind of a defined processes in terms of the haircut and what have you. And when you overlay the OTCs, the ISDA, CSAs, and all those different things, actually created a lot of disparities. And firms were struggling to figure out a holistic view about how all the pieces come together and what are the big stresses or the big challenges that they would need to worry about. And there was kind of, if you talking to some senior folks, it was not easy for them to think about in the utopian world, you want to have a dial that says that, I'm now operating in a high risk world or a high volatility world. I want these operations to change and things like the haircuts to widen a little bit. And I want these things to be more intraday. That is kind of the utopian world, but I think there is a more and more awareness of people thinking that capability is something the future will actually demand. The way we think about it is that even the firms that were finding collateral or operational processes kept up, it was hard to figure out what is the best way to meet all these margin and collateral requirements, or broadly speaking, obligations. So the word optimization gets thrown around a lot, but I think there is a lot more appreciation for ability and the need to optimize, not just within a business, but maybe across multiple businesses or across time zones or across regions. And that is another thing that we are seeing that is more of a observation in terms of analysis and the value as the firms are thinking about it. If I look forward in terms of the lessons learned, I think I go back to the point that industry overall did very well. There were no other undue risks, but it took a lot of hard work and a lot of blood, sweat, and tears to get to that stage. So if you think about how do you keep it up or how do you make it better for the next time such event happen, and by the way, by no means we are out of this, right? So we are living through this. So it's maybe too early to think about lessons learned, but based on what we see, at least I think there are a few things or a few themes that are emerging, and there are a lot of other discussions, whether it's through panels or other articles. I think we expect there is going to be a bit more focus around centralizing or at least more centrally coordinated collateralized businesses as well as their operations. So I think that is one theme that we expect to continue. That has happened in many firms, many areas, but we think that that trend is probably going to increase in focus, whether it's organizationally, operationally, technologically. Every firm will probably make a different call on that, but that theme will happen. Second big theme that we think about that as this lessons learned will drive is what we were talking about earlier around this whole intraday / real-time infrastructure. A lot of the collateral and liquidity infrastructure that is built today is built on a T+1 basis for the most part. Like I'll see what is going on and I'll look at risk and see how things going on. I do think that, go ahead, Mark, you had a question?
Thank you, Bimal. A couple of things that I think would be interesting, interactive from the audience coming in here. One question, which I think was probably prompted by your comment about centralization, etc. Question is, would greater use of CCP in securities finance have made the process easier, less troublesome for the marketplace in recent months?
So I don't know whether maybe James is more qualified to answer that question. At least from my perspective, I haven't heard business or operational challenges of the bilateral businesses, but I think maybe consistent processes or maybe more expected things, maybe standardization maybe would have helped, but I'm not sure whether bilateral versus CCP would have made dealing with the crisis better or worse. Maybe James, you have a view on that?
I think, I don't know whether or not it would have made it better or worse. I think having one central source of operational data and one process for adjusting margin is probably more efficient than having the bilateral web of relationships that we have now. However, obviously CCPs come with other challenges and other factors, which is why you know, their use within securities lending has been underwhelming to date, which doesn't mean to say they won't have a big role to play in the future, just that for traction has been slow. And so obviously there are good reasons for that. So, but I can see in this type of environment, in this type of situation where, you know, there's a lot of fast moving collateral moves, margin calls, etc., having one place to concentrate that in is probably going to be advantageous.
Thank you, James. What I'd like to share with the panel and the audience the results of question 3, which I think would be useful, Bimal, to have you reflect upon, and then others can perhaps join in. So the question was, how satisfied have you been with the technology that you have depended upon during this crisis to date? I'm quite encouraged to see 29% very satisfied, 31% quite satisfied. So 60% are kind of above the line on the positive side. 27 are slightly, it was fit for purpose. 12% somewhat problematic, and only a very small 1%, and I would hasten to point out the point that there's 200 participants on the call, so maybe 1 or 2 people very dissatisfied. So it would seem as though the technological infrastructure is delivering on the upside. Bimal, back to you.
Yeah, no, I think, and actually that is what I would have expected in terms of the answers as well, purely because I think overall industry and most firms did actually very well in keeping up with everything. For a crisis of this magnitude and disruption of this magnitude, I think that is a lot, and I think that is very, very promising. Our observations are about that it is not just technology, but it is about all these other things that actually kept it that way. So the way to think about it, at least the way we think about it, and some of the clients' discussions has been around how do you kind of take everything that we learned from this, and in crisis, everybody operates a lot more efficiently. So to get that level of efficiency on a BAU mode, how do you go about it? And I think this is where we think the lessons learned, the strategic focus areas on a going forward basis is going to be somewhat shifted. And it's not because, the technology was crap and I need to improve. It is because that, okay, we need to prepare for these types of situations in a better, more proactive, more strategic manner. And going back to kind of my themes, I would say that the intraday real time would be a big important thing for us. But equally importantly, and I think James was alluding to earlier, that managing analytics, liquidity, risk was a bit of a challenge during these things. We think there is going to be a more concentrated effort around looking across collateralized businesses around the analytics, the optimization capabilities, looking at the risk aspects of these things from a collateral and liquidity perspective. I think there's going to be a more focus around creating that type of an ecosystem. And last but not the least, but I think this is an important part is and this is maybe an utopian thing, but industry is definitely making progress in that, is that now that you decide and you may think that, okay, I think this is the best thing for me to do, but it may mean for me to move this, post this collateral to this CCP and this to some other CCP and post this to bilateral margin and this on my tri-party repo and this is for non-cash borrow. All that is a fairly daunting situation. So an effective operational system that can make that happen, broadly speaking, so that you can execute, and somebody used the word that creating a frictionless collateral movement system, that's an important thing. And it's not a industry thing, it's equally importantly internal for the firms to get that right, as well as connecting to the rest of the ecosystem. So I think there is few themes that have emerged, and I go back to the point that we are still living through that. So we are by no means done, and we probably will continue to learn, and maybe dialogues like these will help us figure out which of these themes are more important and more critical for us to focus on, and we'll see how that that evolves. But I think it's a exciting time in terms of the future capability. There's no the famous line around never let a crisis go to waste. I think this crisis is going to become also a catalyst for change in terms of investing in broadly speaking collateral liquidity ecosystem.
Thank you, sir. And that links us to a question that's just come in from someone in the audience, which is, I think, links in very nicely. The questioner poses this question: what tools will be needed for the buy side if such events happen again? And I suppose it's one thing to kind of take a view and have a view on the systems and tools you have and how they perform, and that seems to be broadly a very positive message. But it's more difficult sometimes to work out what you haven't got that would have been helpful at the time. And I don't know if you, Bimal, or others in the panel have any thoughts on that. It's a quite existential question. What did you wish you had but you didn't have in the last 3 months? Is there anything that, apart from obviously online margining and intraday, all of that type
real time,
but anything else that comes to mind? It's a great question.
Let me start, and I think I'm sure there are a lot of people on the panel can opine on that. But one thing we feel that the buy side, for a large part, kind of delegates the collateral management and a lot of these capabilities to the dealers or their prime brokers or somebody like that, or their custodians. We feel, and talking to many of the buy side players, we think that there are more of them trying to take more control over those things, whether they want more visibility, want more control, they want to be able to act on certain things certain way, whether the crisis like this or the UMRs of the world will be actually driving that shift. What exactly it turns out in terms of the tools, I think there are a lot of guesses and there are a lot of ways different players are positioning. But I think it's probably time will tell exactly. But broadly speaking, increased visibility in real time and ability to apply analytics and optimization on their portfolios, I think is something that they would like more control over. But I'll open to other panelists if you have a specific.
Any thoughts, gentlemen, before we move on?
Yeah, maybe I'd like to add something. I mean, we said we have been like kind of complaining a little bit about the old-fashioned way the sec lending collateral management and the repo collateral management is being done, but it's also fair to say that at least we are settling same day. I mean, like Bimal and also James mentioned that on the derivative side, like we still have a lot of CSAs with settlement T+1, and so at the same time, I do think that it would be ideal or possible to find the best from two worlds. Basically, when we have something, Bimal mentioned the UMR regulation and the SIM methodology for calculation, with like external vendors providing the calculation and the matching. So aligning that with, we say, the same-day settlement of the sec lending repo margining, a little bit of more technology, volatility, one-way risk addition into that, and the skew of the portfolio as well could be something like that will make a big shift and progress into the securities lending and the repo world. On top of that, it's obviously the need for everybody to move to, I would say, a more a fluid settlement. So people are working about token methodology so that there is no like physical settlement, but we are sharing tokens when exchanging collateral. I get that the need for people to move to tri-party and an integrated tri-party, I would say, environment will make also a big change. And it's very important that people start to understand that the bilateral world is kind of it's getting old-fashioned, and we really need to move to something more centralized when we have like people specialists of the calculation and the valuation, and people specialists of exchanging or circulating collateral, but like sending instructions on a manual basis it's getting old-fashioned. So we need to make a step further. But I would say that a part of that, I mean, like people in the industry have made very, very good, I would say, have gone well through the crisis or through the first months of the crisis. It's getting more quiet now, of course, but I mean, like settlement have performed, and there was obviously, as it's been mentioned, like a lot of requirement from the risk teams to be sure that everything was settling in due time, concentration of the portfolio, so on and so forth. So we had to also split a lot of indicators, and those kind of indicators could also be like guidelines in a future world of organized collateral methodology.
Thank you,
Thanks.
Simon. I wonder if we might move into your section now. We've got a pile of different questions, which, if you don't mind, I'll disgorge to you, and you are prepared for them.
My pleasure.
By the end of March, the boards of many firms, for their own reasons or from external reasons, had suspended dividends and buybacks and those kinds of things on ordinary shares. Some outstanding dividends for this 2019 were also cancelled. Has this uncertainty impacted the market as you see it? And have counterparts found an amiable way to resolve any disputes? Or are there lawsuits brewing in the industry between people competing about, well, it was a fixed trade, the dividend was factored in, the fact it's cancelled is not an act of God, it blah, 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 all of these kinds of things. And I think just generally, news from the front, if you like, what have trading conditions actually been? Because I know the audience is made up of lots of different people.
I'd like to start with the very beginning of your first sentence.
Okay, sir.
Meaning for several reasons. And one of those many important reasons was outside the extraordinary circumstances and the potential expectation of results, even though dividends are supposed to reflect the performance of the previous year. You don't have to forget that. Like, we have also like the political environment stepping into the private management of a firm, and it was kind of surprising to see governments pushing companies not to distribute. In the US, it was even like much more than that. So it was like about distribution and also about buyback. And this was very, I would say, not surprising, but not expected at all. Dividend-wise, we've seen like extraordinary moves. In Europe, it was minus 60% within 3 weeks. In the US, it was minus 40%, same within 3 weeks. We are now back to levels that are closer to their original. For example, in the US, we are only 10% below what for I would say the year 2020, we are 10% below what the dividend were early Feb. So it's like we had a massive shock, overreaction for from a lot of market participants, mainly due to indexation products and the protection that was needed. We have to remember that for the last 9 years, it was like market was, I'm talking about the US market, was like up, like a straight line, and dividend were like growing every year, and even sometimes like extraordinary distribution, so an additional dividend. So for people in the industry that are like fairly young or new, that have been only living for those 10 years of experience, like the fact of having like such a shock in dividend was something that potentially they could not even imagine. More than that, it's also the fact that an announced dividend could be cancelled. So this is also, I would say, a new kind of risk that companies, bank, obviously, will have to take in account. So how do we consider I would say, which factor do we have to put in this risk? Because it's like, we cannot say that the whole dividend is at risk at all time and in all market conditions. But this is something that now we have to obviously take in account. I was talking about the de-risking of the structured products. obviously a lot of autocall structure. So when the market is going up, like the autocalls are basically exercised, purchased back. And now we had like a lot of protections to come into play with a very significant amount of autocalls, getting like much further from the barriers. And it's also like generated, I would say, an extreme reaction from market participant. At some point, people wishing to exit their position and generating an additional stress to a trader trying to, I would say, control and hedge this risk. If I want to move a little bit on the other question you've been asking about the counterparty risk. Let's say that we have not, and it's been said by the other panelists, it was not so much of a counterparty risk in that space. I mean, say most of the people in the industry were fairly comfortable with what was going on, especially in the equity world. I would say the perception was completely different in the credit and structured product space. I mean, like we were seeing like products not quoted for weeks, and maybe like the first quote was 60 or 70% below the last one, and no real or objective reasons for that. So it's also the fear of, or the difference we have to put between the market value that you have to collect and to, I would say, assess and to establish the value of your risk, and the, I would say, fair value of an asset. So we are very lucky in the equity world because we don't really, I would say, it's not care about the fair value, but we have something that is quoted and objective. In a gray market, it's like far more complicated to take a decision.
Simon, couple of other questions before we move on to maybe some from the audience, which are stacking up. I'm very conscious of that. You talked about political involvement in dividends and distributions, but also we have seen some short selling bans, and some institutions have decided to maybe temporarily or maybe for longer leave the market. Has that supply side externality shock impacted you and the market, do you think?
I think this I mean, like there is already like a short selling rule in place in the US that are kind of moderated the strengths of the short sell. So this even with that those rules in place, as James said, you've seen like 8 days in a row of -5%, and the rules enforced or come into play much earlier than 5% decrease. So it doesn't stop when there is a massive trade of long-only investors deciding to exit a position. It doesn't, I would say, prevent from the trend to start and to continue. Probably in Europe, it came into force a little bit late, but however, it clearly, I would say, put some kind of more stability and less stress in the environment. However, it's true that we have seen some valuation of companies going to the ground. Yes. I'm obviously talking about the airliners, where basically if you were just counting the number of planes times the potential price of a plane, it was like ridiculous to see the price of the company. And I would say the same for rental company. I mean, like I will not mention names, but we all know what I'm talking about. So this is what we are at some point calling overreaction and like uncertainty about the future. I mean, like when you can't see any cash flow because there is a travel ban, because you cannot take a car, because you cannot move from your place, for sure, like it's potentially the actualization is zero, even though you still have like planes to sell and car to sell. So it was very interesting for that.
Thank you, sir. Thank you, Simon. I'm keen now with 13 minutes left before we all start going to our next Zoom meeting. No problem at all, sir. Nigel, I'd be very keen to draw you into your section. And thank you for being so patient. Couple of things that perhaps set the scene. Question 2, 39% of the respondents said that they did note increased difficulty locating or mobilizing sufficient collateral in recent months, which meant 61% didn't. So I think that might play into some of the things that we talk about, Nigel. The other key statistics, so far we've mentioned the phrase working from home 3 times, well done, and unprecedented, and I think this is basically James, twice. So thank you very much. Nigel, your section. How have the UK and European government repo markets, cleared and uncleared, performed in these difficult times, and how have volumes been?
Thank you, Mark, and thank you for my former panelists, because you've actually used quite a lot of the lines that I was going to use during my my notes that I made here. So we could make this pretty quick, but in general, the overview, we see things through a slightly different lens. We're a CCP, we're operating in the European and UK government bond market. Things have held up very well. The general consensus among the players and the members of LCH Repo Clear is that things have held up very well during the crisis. And we have to remember, you know, to James's point, the thought of trading from home was always a no-no. But we have to remember this wasn't just about trading from home. This was about the whole company going home. Now, from front to back, compliance operations, settlement operations, etc., etc. And I'll go on to that bit in a minute, because we certainly saw some dislocation, which I think the market took in its stride, as far as the settlement efficiency. I'll talk a little bit more about that. But maybe back to the volumes that we witnessed. You know, I'm not going to use the term unprecedented. I'm going to use the term extraordinary, which I think we agreed in the pre-session. I've made the note here. We did see high volatility. LCH sees perhaps the end result of many collateral transformation trades in HQLA paper. And we definitely saw the requirements for meeting margin calls. And I think this was probably the interesting part here, is that the market, having gone home with reduced capacity, is the first point. The second point is that we were also coming up to a quarter end, and balance sheets aren't unlimited, and those that were operating at full capacity perhaps didn't have the capacity to take up the slack from those who were winding down operations to a certain extent, whilst they rebased their operations in their home offices. And I think that's the stress point that we saw perhaps in the market, or we heard in the market. As a CCP, we don't see it directly, but we hear anecdotally that, you know, there were some issues, some difficulties in retaining the financing that would be required, particularly over a quarter end period at the end of March. So that's sort of setting the tone. Market working very well. Perhaps some dislocation caused because of operational reasons, but also heightened demand at a time when people were scaling back operations a little bit because of the physical situation that we were in at the time. So where does that lead to in terms of the settlement efficiencies, which I talked about? Yes, I think everybody, you know, knows that settlement performance didn't perform as well in the lead up to, during, and just after the crisis. It did recover very, very quickly. We ourselves, LCH, have been working actually very hard with our members over the previous months, and actually during 2019 as well, to increase settlement efficiency. So we were able to quickly accelerate that process and put more resource into it, and to help to mobilize that collateral and push it around the system even more. Mark, you've just put your finger up, so.
Nigel, thank you for noticing that. I wonder if I might play in a couple of questions that have come, I think, pertain to this concept of efficiency, etc. Thing one, or question one, do you think that the COVID crisis has accelerated or slowed the move towards the digitalization of financing markets, such using distributed ledger technology, tokenization, etc. Is this something that you're hearing people wishing had been more advanced and are encouraged about and embracing more closely, or is it everybody's too busy at the moment and they'll work that out later?
It's something which I think was mooted upon during 2019 and the early part of 2020. I think it's gone incredibly quiet in the period between then. I can see Bimal shaking his head as well, and so perhaps he's closer to this technology, because it is really a technology solution than a CCP solution. But I think at the moment we're rebasing ourselves. Just as a general observation, we have started to see a pickup in the number of people thinking about how we start to develop our business going forward. We definitely went into a period of about six to 8 weeks where people were rebasing and going into a period of not convalescence, but certainly, how do we cope with this market? Into now, well, in fact, we still have to do our business and we have to grow our business going forward. So I fully expect that those conversations will come back in very short order.
Thank you. One other question, which I think cuts to an area, we've mentioned the word collateral almost more than anything else during this conversation. It's not surprising because everybody wants to make sure that they're properly and their clients are properly protected. Here's a question. Firms in Europe have spent years driving collateral efficiency through the consolidation and expansion of collateral pools. As firms have to segregate activities, brackets due to Brexit, that word will be back on the front pages no time soon, I'm sure. Will some of these efficiencies be lost as that segmentation does occur? Is that something that is, again, I mean, it's not a COVID related issue, but as one sort of lifts one eyes from the current situation, is there, you mentioned the word efficiency and collateral management and all of those kinds of things. Is that something that your clients are concerned about a little bit? I
think they're definitely concerned about it. I'd like to actually just rewind a little bit into something that happened during 2019. Was that as a CCP, we were split in our Euro business between two CCPs, one based in London and one based in Paris. Two different legal entities essentially doing the same job. And we've, for many, many years had our members asking us, please, can you do all of this in one place? Because exactly those efficiencies that you talk about. And one of the, case in point to this is that this took us time to develop the capability for that to happen, but it took 3 days to move the liquidity. Not for us, we don't move liquidity, but for our members to move liquidity, it took roughly 3 days for 90% of that liquidity that was in one CCP to travel to the other. So I think that just demonstrates the thirst for efficiencies like this.
That's a great live example of what's going on.
Mark, could I just jump in briefly?
Of course you can, sir.
I just wanted just to go back to the DLT question, because I agree. I think it's a really interesting area, and I agree with Nigel in that I don't think anyone's really had time to work on digital ledger technology over the course of the past 3 months for sure. But I think what this whole period has done is demonstrate how important it is that as an industry we get on top of some of the inefficiencies which are still there, particularly around settlement and contract compare and billing compare. Like there's just a lot that doesn't work as well as it should do. Settlement failure, collateral efficiency, to bring that up again. And it does feel like that there's an acknowledgement, there's been lots of discussion on, well, how do we get to that level of efficiency that we need to? And is that digitalization? It could just be SFTR. It could be the fact that we now have more standardization and we'll be able to piggyback off that. But I do think there's been lots of discussion still on how we can fix some of the issues which have been exacerbated through the COVID crisis, because there's just too many operational inefficiencies still. And DLT, maybe amongst a bunch of other things, the thing that enables us eventually to fix some of those issues. Or it may not be, but it's certainly part of the conversation.
Thank you, James. couple of other questions that have come on from the audience, and I feel we're getting to them, and I'm trying to weave a web here in a story. James, this might come back to you, but others I'm sure would have a view. Your fearless leader, Mr. Fink, made himself relatively famous with regard to the ESG comments that he made not that long ago, although it seems like a lifetime ago, quite frankly. And we've got a question on ESG, and it's sort of ESG and collateral related. Everything's got a collateral angle, it would seem today. Were ESG principles assigned to collateral acceptance maintained during the heightened volatility, or was that set aside to just expedite efficient collateralization? It's an interesting, detailed question, but any thoughts on that?
I mean, I don't think it was set aside. I think that if you're an ESG investor and as an asset manager or an agent lender, you make commitment to those clients in terms of how you're going to manage their collateral. They are not going to, you're not going to change those commitments because the market's more volatile. Now, I'm not sure at the moment how sophisticated some of those collateral arrangements are in terms of being able to mirror exactly what clients want from an ESG investment perspective, for collateral perspective. I would say, while we're talking about ESG, I mean, that's certainly one of the strong trends through the past 6 months, both in terms of flows. I mean, the flows that we've seen into ESG have been 4 or 5 times what they were last year. It seems like it's becoming very real. Yep. And performance of ESG funds has been very strong through that period as well.
Excellent, thank you. We have one more question. I'm determined to get this all done, and thank you the audience for sending these questions in. Simon, this one's got your name written on it, I think. Questions, it's on short selling, bans and quantitative strategy. How do you feel that quantitative funds trading activity has been restricted or impacted by the European short sale bans? Have you seen that manifesting itself in demand in the marketplace?
Unmute, of course. It should happen. I think, as I was saying, I mean, like there was an impact. I don't think that the impact was that strong. For several reasons. I guess that first of all, the ban came a little bit late into force in Europe, and at some point, I mean, like you also have some like in the clear short sale world, you may have some also a capacity either to use I would say external provider. That might reflect the position on our derivative format. So clearly, I think that there was, or it generated a certain restriction or limitation in the strength of the, I would say the short sale capacity. However, I don't think it was 100% neutralized. And as I said earlier, it came a little bit late into play.
Thank you, Simon. Right, we've had an interactive session, and I'm delighted to say we still have 163 people listening. Maybe that's including us, but well done to them. And I think that's a reflection of the conversation that my panelists have been able to drive. And we do thank you for the questions. I wonder if I might ask, in no particular order, but actually perhaps in the order I can see on the top of my screen, James, Bimal, Nigel, and Simon, to maybe just give a 30-second sort of reflection and closing statements before I move to my thank yous. So over to you, James, 30 seconds if you may.
Sure, thanks, Mark. I mean, I think just to finish up, maybe in 30 seconds, we should just look slightly ahead to see what this crisis is really going to be kind of looked back on in terms of a catalyst for change. And I think it's really been what we see as an acceleration of existing trends, but those trends are kind of moving very quickly now. So we've touched on ESG, central banks, which we kind of mentioned at the start, but definitely their role is huge now. Bank of England's balance sheet is 40% of GDP, and in the year 2000, it was 5%. And so, you know, the impact that's going to have on markets in the future, things like the use of ETFs as collateral and fixed income ETFs, which had a very good crisis, I think is also going to, you know, they're going to play a bigger role in the future. And then we haven't really touched on this, but definitely inclusion and diversity through working from home and more flexible working is something I think hopefully that's here to stay as well.
Thank you, sir. Bimal?
Thanks, Mark. Yeah, no, I think main thing is that the technology for the most part held up in the industry, and I do think that's a great point. But at the same time, there are a lot of lessons learned, and our view and general kind of going back to what James was saying, things like real-time intraday capabilities, things like central coordination of collateral and liquidity, things like analytics and optimization and risk of these activities, and a clean and seamless way to act on the decisions that this technology may provide to you. Those are the themes and those are the trends, and we see clearly that the industry is going to move its focus once we get back to normal in those directions.
Thank you, sir. Nigel?
I just wanted to reflect on a question that came in earlier about, you know, should we be moving more towards the CCP model? It's a little difficult for a CCP perhaps to comment on that, but I think what I would like to say is that CCPs perhaps can become part of the toolkit. We are ourselves working on solutions, and we've delivered solutions that are working very well to allow buy-side access or windows into the CCP liquidity. It increases their access, it increases the efficiency for the sell side in terms of their balance sheet usage, overall retaining capacity and allowing perhaps that balance sheet to be used for other transactions within the marketplace. So I think just as a CCP point of view is we see it as our job to continue to expand access into this multilateral netting world that we have as part of the solution going forward.
Thank you, Nigel. Simon?
Yeah, I mean, like going in last year is not that easy, but let's say that for me, it's like a new version of risks to monitor. This is something that is very important to keep in mind. We mentioned technology, and for sure, it's once again, it's all a matter of investment. I mean, like we've seen that in obviously the work from home and the need to get like obviously a computer, a virtual desktop, and so on and so forth. And yeah, maybe move a little bit to a more digitalized infrastructure and technology for real time. James was also mentioning something important. Is like is our pricing accurate in some of the transactions we perform, in the balance sheet we deliver to customer, in the real profitability of the trades that we do. So are we sure that we take everything in account and the risk measures are properly accounted for? And after, it's also like on a more general basis, is like what are we going to do with all that debt? I mean, like it's amazing the amount of cash that has been injected in the economy. The Fed giving like full capacity for primary dealer and with no balance sheet capacity for the next year. It's like it's something that is crazy when you think about it. The governments, or let's say the authority or regulator, are doing what's necessary to I would say calm the market and make things as smooth as possible. But when you see plans that are being delivered trillions and trillions, it's just like, who's going to pay? What's going to happen? I mean, like, do we really consider that it's normal having like a market going up for 10 years? I don't want to be the black swan, and not to finish on that note, but it's true that at some point valuation, in some cases, look to be like far from any reasonable value.
Thank you, Simon. What I'd like to do is just thank everybody for their time. It's working from home 4, unprecedented 3, and no schedule. The flamingos are not real. I'd like to thank the organizers. I'd like to thank the sponsors. I'd like to thank my panel. And I'm going to wish you all good luck working from home in the future, which I think has now been rightly renamed sleeping at work, which is, or living at work. So I want to thank you all very much. Thank you for the audience, for their questions and their engagement. We've still got 127 with us, which is fantastic. It's a testament to you, the panel, and the organizers. Thank you very much.